Welcome all. Today we are going to discuss 2018 Strategic Financial Management past paper HNDA question number 5B. Start manufacturing company has a total capitalization of 10 lakhs and it normally earn 1 lakh before interest and taxes. The financial manager of the firms want to take a decision regarding the capital structure. After study of the capital market to be gather the following data. They give us the capitalization and next they give earns before interest and tax. Right, copy that. They give us the table, amount of debt, interest rate in percentage, equity capitalization rate at given level of debt, percentage, right. Assuming corporate tax is 30%, that firms always maintain its capital structure book values, right. Tax rate is 30%. But they ask what amount of debt should be employed by the firm if the traditional approach is held valid. Next they ask if the approach is followed, what should be the EBIT capitalization rate. Okay, that's the optimal capital. Tax 30% is equal to 30%. It is 30% equal to 0.3. Let's solve the question. Right, rupees. Copy the table. First line, amount of debt. It is 1 lakh to 7 lakh. Yes. Next, interest rate in percentage. To 7. Next, equity capitalization 10 to 20. Right, copy the table. Next, you see equity capitalization. They give us the capitalization is 10 lakh. See the amount of equity. How do we calculate amount of equity? Amount of equity, we calculate the total equity capitalization minus amount of debt. Likewise, get the other value. Let's see the weight of equity. How do we calculate weight of equity? Weight of equity, we calculate the equity capitalization, amount of equity divided by total capitalization. Amount of equity divided by total capitalization. Get the other value. Next, we will see how do we get the weight of debt. Like weight of equity, get the amount of debt divided by total equity capitalization. Amount of debt divided by equity capitalization. Like get the other value. Next, how do we will see how do we get the cost of debt after tax. Cost of debt after tax, we get the interest rate multiplied by within bracket 1 minus the tax rate. Tax rate is 30%. 30% equal to 30% equal to 0.3. 30% equal to 0.3. So how do we get the cost of debt after tax percentage? It is get interest rate multiplied by within bracket 1 minus tax rate 0.3. Likewise, get the value interest rate multiplied by 1 within bracket 1 minus 0.3. Likewise, get other value. Next, we will see how do we get the WACC. How do we get the WACC? WACC equal to equity capital multiplied by weight of equity plus cost of debt after tax multiplied by weight of debt. Again, how do we get the first one? Let's see the first one. Within bracket equity capitalization rate multiplied by weight of equity plus cost of debt after tax multiplied by weight of debt. Likewise, get other value. What optimal capital structure is the minimum value of weighted average cost of capital. It is 8.51. What is the relevant amount of debt? It is 5 lakh. Amount of debt is optimal amount of debt 5 lakhs because lowest the weighted average cost of capital. What they ask next, if the approach is followed, what should be the equity capitalization rate? Okay, next they ask equity capitalization rate. How do we get the equity capitalization rate? Equity capitalization equal to EBIT divided by total capitalization. How do we know EBIT? Yes, they give us earnings 1 lakhs before interest and tax. It is EBIT is 1 lakh total capitalization is, they give it in total capitalization is 10 lakh. So now we can get the answer. The amount is equity capitalization amount is 1 lakh divided by 10 lakh. It is 10%.